been a volatile last week or so for the bond market in Nigeria. The market obviously reacting to the change in government policy with regards to the purchase of debt in government debt. A one-year holding period has been cancelled. Now you can hold debt for as long as you wish. You can buy and sell whenever you like as a foreign investor. Joining me in the studio, however, to take a look at the last 6 months and, of course, what to look towards the next 6 months is Akin Dawodu. He's the President of Financial Market Dealers Association and Group Treasurer for Citi in Nigeria. Thanks so much, Akin, for joining us in the studio today.
Thank you, Wole.
First of all, let's get a sense of your thoughts on the volatility we've seen over the last 1 week. Is it what you expected? We've seen a lot of demand, but is all of that demand really foreign? Because I do know that the policy actually did just take effect from July 1.
Yeah, well, the volatility was expected to the extent that what has changed with the new rule is that the demand side of the bond market has been adjusted. There's potentially new demand from offshore investors that may not have been there before because of their concerns about the one-year restriction. So in like basic economics, in any relationship where demand increases, typically the price falls. In this case, our price goes up. In this case, yields go down, which is, so that was expected. The extent of it, you know, who can really predict how far these things will go? But it was expected, and there have been some flows, I believe. But also, the perception of the flows is almost as important as the reality of them. So the political saying that perception is reality. It's true in politics, I think it's true in markets as well. So there are some flows. There's also the perception that there will be flows and that there have been flows. And I think there will be. So well, the market was getting ahead of itself a little bit, but understandably so.
I'll touch on the foreign exchange market, because it also has a bearing on the bond markets. Recently, more so because of the change in policy from the central bank. But first of all, the story for the first half obviously has been interest rates. We've seen the MPC raise rates, and that has obviously filtered down to bond yields. What are your expectations going forward in the context of where inflation is and what to expect for yields going forward?
Well, that's a very interesting question. I think the change, effective July 1, is a new variable that kind of changes the outlook one might have had before that change was enacted. Yes, interest rates have been going up all year. The central bank has raised the policy rate by 175 basis points this year. But the real key change in interest rates occurred in September last year when they moved 25 basis points against all expectations. And the bond yields adjusted then to such an extent that by November we were at all-time highs in bond yields in the 3, 5, and 20-year segments that effectively have not really been breached despite the 175 basis points of hikes this year. The market, after that surprise move in September, priced in a lot of future hikes. And as a result, only after the 100 basis point hike in March did we see yields touch those former November levels again. So the market adjusted, and this year it sort of traded sideways. Yields went down in the early part of the year, rose sharply again post-MPC, and now are going down again because of the foreign inflows. In terms of inflation, inflation is still the challenge. We're at 12.4. The aim is to bring it back to single digits. I don't know whether that will be doable this year, especially when you consider the expanded base effect. Essentially, the second half of last year, inflation was dropping. So unless the inflation rate itself is dropping significantly, the chances are inflationary pressures will continue on a year-on-year basis in the second half of the year. It will be tough to attain single digits. So that means central bank will probably still have to be active on the monetary side in terms of maybe 1 or 2 more rate hikes, maybe smaller than the last 2 we've seen, but still direction, some things that point the direction as to where they want rates to go. Maybe direct policy actions like the cash reserve ratio, maybe more open market operations. And especially with the foreign flows coming in and creating fresh liquidity, the need to do that is probably heightened a little bit, especially if inflation is going to be kept in check.
Finally, let's touch on the foreign flows and the impact that they're going to have on the exchange rate, because that is, I think, for me, a very key variable in this whole dynamic. We've seen the exchange rate pretty stable over the last 1 week, obviously reacting to that new policy. What are your thoughts on where the Naira will be against the dollar going forward in the context of where the foreign flows that we're expecting, and of course with the central bank's moves to tackle inflation?
Well, to be fair, the exchange rate hasn't been stable over the past 8-9 days. It's actually, the Naira has strengthened significantly.
Well, I mean strengthening, obviously.
On the interbank market, Naira has picked up 3.8% or something like that,
right.
which is very
That's
sharp.
correct.
And at the central bank, over 1%. I expect it to revalue further today when the results of today's auction come out. Again, the July 1 change is really a game changer for the markets, especially if it is sustained. It changes the way the markets work. It changes the way the central bank itself has to manage the market and respond to it. It changes the way us as market operators have to play. We have to factor in a lot more. And one of the first things it is impacting is the exchange rate, because Nigeria has a positive carry, double-digit interest rates that are attractive to offshore investors, and oil prices relatively well supported, economic growth still strong. Nigeria is a good play for them to get into. Fiscal constraints being the only worry, and the runaway fiscal profile of the past 2 years has been a concern. But with spending under control, hypothetically, then the outlook for Naira could be very good indeed, supported by physical flows. So the perception is that there will be flows. The reality is that there has been, and it's a question of how far this will go and how quickly.